Hello, everyone, and welcome to the PivotBoss Hangout for February 2015. This is something that I've been doing here for a few times. This is the fourth time now, and I want to welcome everyone. First of all, my name is Frank Ochoa, aka Pivot Boss, and I'm the author of the book Secrets of a Pivot Boss. You can find me at pivotboss.com or on Twitter at PivotBoss, and many of you obviously know that because you're here right now. But what the purpose of these PivotBoss Hangouts is to provide a market outlook for the month. And I'm trying to do these the first trading day of the month, or the first Monday of the month. And basically the goal here is to provide an outlook for the rest of the month, and also to basically get in front of other traders and provide analysis and some education, free education. Just provide a way that I look at the markets here, because I think it really does translate across any time frame, across any trading style, and any instrument. And that is special. That's something that's very, very special, and it's something that I worked very hard on for at least the last 10 years now, developing this approach. Because the first 5 years of my trading career, it's looking at everything and trying all kinds of things and figuring out what works and what doesn't. And my whole goal was to identify an approach that allowed me to analyze and trade the market with accuracy in any time frame and for any instrument. And it almost was kind of this whole plan was derived mostly from laziness, because I didn't want to learn new tools and new things for every instrument I traded or for every time frame. Instead, what I wanted to do was develop an approach that relied on price and volume. And that's it, because price and volume is prevalent in any time frame. And so what I'm going to be doing here is just providing an outlook for the ES, for the NQ, for gold, and for crude oil for the upcoming month, and even down the road even farther. But do that with the approach that I use. And I call this approach the PVV method, which is price, volume, and value. And when you can analyze the market through the lens of price and volume and value, you can analyze the market with a high degree of accuracy at times. And the rest is all about trade management, risk management. Because no matter how great your levels are, if you don't have the right trade and risk management attached, it doesn't matter, because that is really the game. It's keeping what you have and having an approach that allows you to minimize risk and scale out of risk, so that you basically effectively eliminate that risk in a trade, so that you can have free and open emotional capital in that trade and allow the trade to work out in your favor. So what I'm going to be doing here is just starting off with some analysis. Again, welcome to everyone. And let's go ahead and get started here. What I'm doing right here is I'm looking at the ES in a daily time frame. And what I've done is basically created a volume profile around the recent trading range. And I've continued to increase this range for some time, because this range has been developing for 3 straight months now. And if you look at this chart here, let's take a look. Let's bring up a pencil tool here. And basically, if you look at this chart right here, this is your 3-month trading range that we have. And this range basically started after we had expansion from the prior key range through 2007 half. Price rallied to a high of 72.25 right here. That's basically that high right there. And then price auctioned lower until it found the lowest low, which was 1961 half. After that, price rallied and pushed through the 72.25 high, held up there for 4 or 5 days, and then failed to see a further continuation of that range expansion. In essence, that was a failed range expansion. And that led to a reversal back across the range to the bottom of value, basically. And that's where we currently have been throughout the rest of the time. We've been trading below value, back to the top of value, then from the top of value back to the bottom of value, and then back from the bottom back to the top, and then again back down. So this has been something that's been going on for some time, and it's all based off of the recent trading range. So I know many of you probably trade with various different types of platforms. This current platform that I'm using is Market Delta Charts. And Market Delta is I love Market Delta. It's a fantastic platform. And it's not for newbies so much, but I have super platform experience because I worked for a platform company for 11 years, and I developed the software and also developed mechanical strategies, algorithms, and employed those in a fund atmosphere. So this was something that I've been used to for a long time, and it's something that, you know, once you have experience in a platform, extensive experience, you can kind of assimilate that experience to other platforms. So it was a very easy transition to Market Delta. But if you're new to trading, it's not the easiest, but they have a great wealth of education behind the scenes for you. One thing that's great about this is that the platform is that you're able to create these volume profiles on any price or volume data that you want. And that's the profile that I created here. And you can see these dotted lines that come out this way, or dashed lines. And the way I do that is basically by, let's delete this here, and let's bring up another one. So if I bring up my toolbar, there's a volume profile on the toolbar here. And what you can do is select a date range or a price range and just drag it over, and boom, the profile pops up, and immediately you see all the valuable levels that you need to know. The pink magenta line right here, that is VPOC. So that's going to be the VPOC of the range. The black line up here, this is going to be the top of value, MCVAL or VAH, microcomposite value area high. This line right here, which is kind of partly obscured, this black line is going to be MCVAL. So this is basically VAL, value area low. This is the value area high right here, VAH. And then this magenta or pink line right here is VPOC, the volume point of control. And basically, these levels give you a lot of what you need to know in trading in terms of value over and undervalued areas. Because the whole approach is, when it comes to trading, is when you have a market that's trending up, the goal is always to buy pullbacks in the direction of the trend, but to buy pullbacks below value, ideally. And that's what happened here. Look at this. We got a move here, went up, came back, and now, you know, this is below value. It may not have been below value at that point, but this was, you know, essentially what established what was below value. When price came up, now this was below value. Price comes down. When price comes back down, this is below value. And that's why you've seen a lot of buyers come in and defend these levels time and time again, here, 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 and even here over the last 3 to 4 days, because that's typically the goal. On the flip side, if you're a bear, then you're looking to defend prices above value, defend prices above value. Look at this here, here, and here. And that's, of course, in a trading range market as well. So in January, we established probably the best trading range market that I've seen in years for a month. And, you know, it was down, back up, down, back up, and then down. And it was a perfect trading range, and it all had to do with these key levels right here. And these are levels that I provided our premium members at PivotBoss throughout the month. And that's how I was able to identify these levels for trade opportunities back and forth. And now, once you have a range like this, you know, a range that has developed over the last 3 months, and then a range that not only has developed, but is starting to coil toward an apex, it's starting to coil up, this implies impending expansion. So what we're going to look for here is some type of significant expansion outside of this range. And one of the things that I was taught by my mentor when I first started trading, Ed Downs, was that oftentimes price and ranges, they're also attached to time as well. So if this range is 3 months, once we get expansion from this range, we could see a 3-month move in the direction of the break. So that means we could see some significant expansion ahead, especially if it's to the downside. We haven't seen a multi-month sell-off for quite some time. The biggest we've gotten is maybe 3 weeks, 4 weeks. You know, here, right here, this is September high, and then we drop down into the October low. And from the October low is when we saw big-time movement to the upside. And I think this is when I made my remark that, you know, the selling in October usually paves the way for our Santa Claus rally. You know, savvy buyers buy this. I tweeted it out. You buy in the October sell-off, and you hand it off to Santa Claus. And that's basically what happened here. And now, after this big time movement we've seen, we have this range. And this range is great because what happens is after the market trends in one way or another, the market then wants to stop and do business. And this is business right here. This is, the market is only around to facilitate trade between buyers and sellers, right? The market's sole purpose is to facilitate trade. And when you find and establish a trading range, that's all you're doing. You're establishing trade between market participants. Bears are happy to continue to defend prices up here because they believe prices are going back to here. Bulls are happy to defend prices back here because they believe prices headed to new highs, as has been the case for the last 5 years. So this is what happens time and time again in the markets. And what happens is all of these buyers that come in here start to put their sell stops where? You start putting your sell stops below price, below price. All of these sellers start to put their buy stops above price, above these highs. And whichever way this market breaks, it's going to trigger those stops. If it's to the upside, it's going to trigger the buy stops, and that's what's going to fuel the up move. If it's to the downside, it's going to trigger those sell stops, and that's what's going to fuel the down move. So what we're looking for here is further back and forth trading range activity. But as soon as we see expansion outside of this range, I'm calling maybe 2065s, 20 something like that, 2065s, and down here 1965s basically. If you get outside of that zone, you're starting to trigger those stops, and that's when you can see that momentum spill over, and then you can see a huge move. So if we back out of this thing a little bit, you can see the market has been trending higher for a long time here. And some of you that have been around PivotBoss for a long time know some of the calls we've made along the way. These were some of my favorite calls were these tightly coiled ranges looking for expansion. And then we had this coiled range looking for expansion. And then price came back to the top of that range, made a support, and went higher. And then from there, it's just been an uptrend. That's why I've been one of those bulls that have just said, buy the dips, buy the dips, buy the dips, time and time again, because that's the market we've been in. But now we're starting to see something a little different. We haven't seen that continuation to the upside like you would expect in an uptrending market. Instead, what you're seeing is a big time pullback. So if you look here again, this was a big time pullback in September back to October. Well, when it rallied to a new highs, it pulled back like normal and went to a new high, but failed. And then once it failed, it dropped down, and then it could not ever reestablish itself back above those highs. This is perhaps a 3-point reversal, also known as kind of a head and shoulders type of pattern, 1, 2, 3. So this is 1 point, this is 1 point, and this is another point. And when you have that type of pattern, it usually forecasts a downside move. So what we're looking for here is just expansion outside this range. I never really want to be definitive when it comes to we're going to break up for sure or we're going to break down for sure when it comes to a range like this, because nobody really knows. We don't know. We do not know. But we do know that fuel is definitely being created in here. This is all being built up. This is the fuel that will spark the next significant move. And what we're looking for is a move out of this range that's going to spark the next 3-month move. So when you keep that in perspective, we're just finished January. We're coming into February now. If we get expansion sometime in February, that means we could be looking at February as month 1, March as month 2, and then April as month 3. And if this range goes to the upside and we have a 3-month rally to the upside, that almost poses a perfect scenario for sell in May and go away, right? So if this happens to break to the upside and you get a 2 to 3 month trading range, a trending market, we could be looking at a move that takes us into May. And then from May, you may be seeing a lot of traders take profits heading into the summer, and then you'll see the market back off those levels. Conversely, if we break to the downside, it could be the same type of thing. We're dropping down, and we're going to have to see what happens at 1800 because this is a big time level. Below 1800 opens up even bigger downside levels, but this is a big time level to contend with. where buyers will indeed be active at the zone. So the ES really poses some interesting ideas here for where we could see movement. Obviously, we're just going to continue to watch this range. The fact that we're below value short term implies a move back to value, which we got today. Actually, value shifted down from 2021 quarter down to 2005 quarter. So you can see values right here, this pink line. It had been right here at 2021. But bulls are looking to take this thing from the bottom of value back to 57. That's short term. So over the course of the week, what we're looking for is we're looking for the battle at 2021, because this is 1, 2, 3 days right here. It's 3 days where bears have been defending that zone, which means there's 3 days worth of buy stops above that area. If bulls trigger those buy stops through that zone and squeeze the bears, the next key level above is going to be 2044 half, followed by 2057 quarter, the top of value. So that's what I'm looking for this week. If bulls are able to squeeze through 2021s, you likely see a move here and up to here. Now, that doesn't mean we blast off and shoot through highs, because 2050s have been well offered by bears. So expect the bears to come in and defend yet again. Now, the other thing is, if price pulls back early in overnight trading, look for buyers to defend value at 2005 quarter for a shot higher. Failure to hold 2005 opens up a retest back at the composite LVN at 1973, and that's the level where we went bid off of today. As a matter of fact, if you look at the pre-market report that I offered this morning, I said if you see 1973, that's likely a first test buy opportunity, because it is a minor LVN in the profile. And price got to 73 quarter and blasted off to 2017s. I mean, that's a massive, massive move. And I got it within a tick of that level. And of course, our premium members have known about that level, because I've been talking about it for some time. You can see right here, it's been marked. Over here, it says key level, which you can't see because it's behind the thing. But this is a key level. We've had it on the books. We can see we traded off of this zone. We got it here again. Very, very nice level. So we also know that there are sell stops below here. So if price comes back to 73s and can't hold it, watch out below, because this thing is dropping. All right, so that's kind of the higher time frame look at the ES. If we drop down into a lower time frame, let's bring up the ES in a lower time frame. Here we go. The lower time frame is fantastic. One thing I wanted to talk about in the lower time frame was, first of all, the previous week's low, 1982s. You can see I have a lot of levels on this chart right now, and I can actually take a lot of these off. I'm not one that loves a whole lot of lines on the charts, and sometimes it gets that way. But I have all of these buttons at the top of my chart here where I can just pop these things on and off as I go, so that I can clean the chart up if I need to. So, for example, I can clean it up right there, and now we have just kind of price with a few of these key levels that I like. The one thing that's really important here is the previous week's levels. The previous week's high-low close are so important. It's immense. At the beginning of the week, Sunday evening, or Monday pre-market, or during Monday's session, you always have to see how price responds at the previous week's high, low, or close, depending upon where we are. And if you look here, you'll notice, actually, let me pop this back. If you look here, what you'll notice is right here, this is the previous week's low right there. Previous week's low, 1982s, okay? And look how price dropped below those lows, okay? It drops below, comes back to it, makes a lower high, and then drops to new lows into 73s, right? Then it pulls back to that level, still offered, comes back, but this is when things change. That's when things change. That's a higher low. It's a higher low, and then prices went bid through those highs, because this is where bears were defending. Bears were coming in to defend here at the previous week's low. Then they were defending here at the previous week's low. But when this higher low occurred right here, the stops came out. And when the stops came out, price pulled back, retested the previous week's low from above, and then boom, blasted off to 2,000. That's an 18 to 20 point move right there. And it was all based on this previous week's low, 1982. Huge, huge level. And you can see the dynamics off that zone. So that's why I really stress to my premium members and also to my masters traders. Masters is basically our training arm that trains our traders using these concepts with courses, both live sessions and video training. But basically, this right here is all based off the pro price levels that I talked about in our master's training. And from here, price rallies back up. Now, this is the previous week's close right here, right there, and that's 1991 quarter. It is also cyan, but there's also black over it, and the black is also the previous session's close. The previous session's close was Friday, which is also last week, so they're the same level. That's why it's kind of black and blue. You can see the little blue dot here. But at first, price was chopping around the previous week's close, trying to establish direction, and then it broke down, made the previous close resistance, and that's when price dropped into and through the previous week's low. So when we squeezed back up, we ran right into the previous week's close and then made it support and then continued higher. I mean, this is fantastic. So when you start to break these things down, the big time thing to do, especially on the Monday, is look at the previous week's high-low close. In this case, this was failed range expansion. Bears were eager to hold prices below the previous week's low. They attempted it and they failed. And when they failed, the stops came out and the ensuing rally was huge. Now, this test right here was important because when price came back to where the stops came out, that's where buyers came in to defend, and any stuck sellers. For example, if you got short here, or if you got short here, or if you got short here, or wherever, if you got short and you were like, you held on and didn't get out, because some folks do that, you're in oh shit land, right? You're like, whoa, what's going on? So when price comes back to your entry, what do? You get out. So if you're short, in order to get out, you have to buy. That's why levels like this lead to big moves like this, because there are a ton of sellers that didn't get out. So when they do get out, they're going to get back out. They're happy they got out at break even. They buy to cover. Buyers come in to buy as well, and you have influx of buying that leads to this move. So I just wanted to talk about this concept right here because it's fantastic. Additionally, I had today was all about our standard deviation bands, and I created these custom proprietary standard deviation bands based on VWAP. So if you look at VWAP here, here's VWAP is the blue line, and this is 3 standard deviations above VWAP, and this is 3 standard deviations below VWAP. So the red is 3 standards above, the green is 3 standards below. Anytime price comes to 3 standards beyond VWAP, it's typically an over or undervalued situation, and that usually leads to a move back to VWAP, which is value, and then perhaps across the range, and this led to a move to the top of the R3 band, which is the 3rd standard deviation. And from here, this was overvalued. Sellers come in and defend that zone and return price back to value. So you can see how price responded to those zones as well. And these areas have been something that I developed many, many years ago, and have now created algorithms that trade these or signal these and do anything you want based off these levels. And that's the signals you see right here. These signals fired those live real time to let you know that there's a potential opportunity here. So those were the key things to take away from the session here. And in addition to the last hour squeeze. So look how price traded from 11 a.m. Central through 2 Central. And basically that's 3 hours of sideways movement. Not only that, we had higher lows here, right? That's a higher low. And then we had a flat resistance level. That's an ascending pattern. Ascending patterns typically break to the upside, and you can see the squeeze right here. It started, came back, defended the top of the range, and blasted off. So it was, you know, you don't always know direction. You know, you don't always say, hey, this is gonna be a squeeze to the upside guaranteed. But when you have a pattern that develops like this, you know significant late day action could be seen. In addition, when you have a pattern that's ascending, it gives you great odds that you're going to break this thing to the upside. So those were a few of the things that I saw today that were very, very helpful in our trading. And again, what we're looking for is a continuation to the upside. So 2005 quarter is the new MC VPOC. And if price comes back to that zone, you want buyers to defend that area for a shot at higher levels. Failure to hold 2005 opens up a retest back at 83.5 with a shot at lower levels. All right, I think that's enough for the ES. Let's look at something else now. Let's take a look at crude oil. Crude oil is fantastic right now. This is an instrument that we basically nailed. We've nailed this instrument for a good while. You know, nobody really foresaw that this thing was going to drop into the 40s when we were trading 95s or 100. But we did. I know which key levels to look at, and we did follow those expansion targets down and nailed move after move all the way down. And what was interesting about that was right in this zone right here. This was 95s back in the day. And when 95 went offered here and we saw that expansion right into 80, and then the bounce really didn't offer much at all. Instead, it was defended. That's when I mentioned to our premium members that below 80, there's not much support at all. This thing could really free fall. And that's when we started hunting our expansion targets. So these golden lines right here are monthly expansion targets. So what it's doing is it's using the prior month's range, trading range, and it's looking at how wide is that range. And then it's using percentages of that range to forecast expansion targets for the upcoming month. So if this range is X amount of points, then 25% of that gives you your 25% expansion target. 50% of that range gives you your 50% expansion target. 75 gives you 75, and 100. And you can see that once we broke 80, my call was that we would reach the 100% expansion target by the end of the month. And we reached it on the last trading day of the month. What a huge move. And then from there, it was all about identifying pullbacks for a shot at lower levels, right? Because if you're in a downtrending market, you want to sell the rips. You want to sell the rips. So all of these pullbacks become selling opportunities. And one thing that I wrote about in my book, Secrets of a Pivot Boss, which really resonated with so many traders around the world, was how I identified when a rip or dip was happening. Because the old axiom was always, hey, all you got to do is buy the dips and sell the rips. It was like, hey, that's fantastic. I love that piece of advice. And then you go to employ it and you're thinking, well, how do I know if that's a rip or a dip? Like, how do I measure that? How do I know? Well, what I did was, just basically use the pivot range. The pivot range, and it's what I teach in the book as well. This is the pivot range that's developed basically using the high plus low plus close to get the pivot point. And then you take the midpoint of the prior range, and that gives you the top in a downtrending market or the bottom of the pivot range in an uptrending market. And from there, you take the difference to create the other side. And in this case, if you're trending down, the idea is to sell the rips at the pivot range for a shot at new lows. Sell the rips at the pivot range for a shot at new lows. Right? You sell all these pullbacks, and it's not always perfect, but this one happened to be perfect, and this one was good for 11 points, and we nailed it. In addition, once you do that, you can then begin to use your expansion targets as scaling points along the way. So basically, that's kind of the backstory for crude oil and how we've been on top of it in premium. And now what we're doing is we're sitting here on lows. We're sitting on lows. We have a very, very tightly coiled range that developed throughout the month of January. but it's also a range that's been very active. We've had a lot of movement inside that range. As a matter of fact, crude oil right now is trading over $2.50 of range per day. Today was over 3.5. Friday it was 4. I mean, that's significant when you think that crude is $1,000 per point. So when you're trading 4 points of range, that's $4,000 per contract traded. Most pro traders will trade more than one contract because trading more than one contract allows you to scale out of your position and minimize that risk. So even if you're trading 2 contracts, I mean, that's a potential $8,000 day if you catch the entire range, obviously. So that's significant, especially when we nailed what happened down here. So let me zoom in on that because this is very, very important and something I wanted to talk about here. Let's open this up. All right. So my call before was obviously we've been trending down and we're going to continue trending down, okay? And that's basically been the call so far. We have continued to trend down this entire time. And what I was mentioning before was this is the bottom of the prior range. This is the bottom of the key range. This is 44.68. This was the 25% expansion target for January, and that was 44.20. And look how price came below this zone just briefly a couple of times last week and then closed back above it. And that was interesting because we already saw some rejections around that zone before. Price came into it again, and now we're seeing rejections again. So what I mentioned Thursday night to our premium members was that this right here implies failed range short term. Failed range expansion because you have this range right here that had developed, all this trading right here, and then price dipped its toe below the bottom of the range to see if we can get expansion because I was calling for 39.85 as a target. That was the expansion target there, the 75. But instead what happened was we came down below the range and popped back above it by the end of the day. Doesn't seem like a lot, but failed range expansion oftentimes leads to significant moves across the range, usually to the other side of value. And that's what I mentioned Thursday evening. Here's Friday's market right here. That indeed occurred. Price broke back above 45s and the squeeze was significant. And then not only that, but you see this 48 right here? That 48 is the micro composite VPOC of the key range. So you can see this profile right here. I put this profile over this range, okay? And that is the highest volume level. That's value. That is value. 48 is value. And this is part of that PVV method, right? Price, volume, and value. So what I was doing was looking at price. This is the price range. Then I was looking at value, 48s. And what I saw was failed range expansion, that's price. That tells you right there, failed range expansion implies that bulls are defending, that bears are stuck, bears are going to be forced to cover, and bulls are looking to return price to value. That's why value becomes very important. So I said if we squeeze above 45s, we're likely going to trade right to 48 because price will trade back to value after it finds rejection. This was rejection. So there it is, 48's got hit. That's a huge move. Again, $4,000 move per contract traded right there on Friday alone. And then in overnight trading Monday, we had a huge range, rallied up to 50, 56, and then closed above value, reaching the top of value. Unbelievable trading, but it all happened based on this tiny little day last Thursday. So I wanted to bring this to your attention because this is something that happens all the time. Failed range expansion, whether it's failed range expansion at highs or failed range expansion at lows, it usually signals a very powerful reversal because of one fact. Whoever got in below this level short is now stuck and they're forced to buy to cover. So failed range expansion works because everybody that's trying to cause that range expansion is stuck and they're forced to exit their positions. And that's what triggers that move. So this was a significant move up. We're now at the top of value. And overall, crude oil remains within this range, right? 51.72, 43.56. It's a fairly wide range, 18 points But at the same time, it's a range that's very well mannered, and soon we will see range expansion. And when we do, it's likely going to be along the lines of, sorry, I said 18 points, 8 points. It's likely to be along the lines of 8 points. So if we break to the upside, look for a significant rally up of 6 to 8 points. And if we break to the downside, it could be the same, 6 to 8 points down, which is huge. So we're going to continue to watch this range very closely. Overall, what I'm doing is I'm watching to see how price responds to price levels at 50. How's the market going to respond above 50? Right now, everything, if I draw a line, here's 50. If I draw a line all the way over, it's been nothing but rejection at and above 50, okay? That says something right now. That says a lot. That tells you bears are defending 50, the round number, for a shot at new lows. That doesn't necessarily mean they win, though. That doesn't mean they win. That just means that's where they're positioned, because now there's a lot of buy stops that are above this zone. And if those buy stops get triggered, I think the next key move takes us right to 55.55 to 56.16. That's my call. That is, if price pushes through and gains acceptance above 50, I think we rally up to this zone right here. 55.55 is the previous month's high, and 56.16 is the micro composite VPOC of this prior range right here. So if you find rejection here and take value bid through 48, then the market is going to either seek new price discovery to create new value, or it's going to trade to prior value. In this case, it's going to try to trade back to prior value, and that's 56.16. So 50 is going to be the level to watch. Acceptance above that zone takes you to 55 to 56. Rejection at 50 takes you right back down to 45s with a shot at seeing expansion into the 25% monthly expansion at 40.58. So that's my new target to the downside, is 40.58 on a first test basis. So this is getting very, very interesting. We got to see how it plays out. But overall, crude oil has been a fantastically volatile commodity. We've seen lots of great movement off of it, and it only appears to be increasing in volatility here as of late. So again, these downside expansion levels are based on the prior month's range. I have 40.58 as the first level downside target. So anybody selling 50s right now could be looking at a downside scaling target at 40.58 and 37.58. Those are the two targets that I'd be shooting for if I'm selling 50s. You can also scale along the way at value, 48s, and then scale lower. But this is a zone right here where if you defend 50s and it stays below that zone, then we could be looking at further expansion into these downside targets. And above 50 obviously has those key zones above. So if we drop down into the intraday time frame, let's look at the crude oil chart. One thing I like to do, and you can see all the various moves here, and this is all, again, based off of key price levels, right? Price rallied off of these lows, 44s. And then Sunday evening and Monday morning, we rally big time. 46.66 is the low in overnight trading, okay? Now, what's significant about that is that what I like to do is create key ranges. And these key ranges, let's see, let's drop this down for a moment. All right, these key ranges right here. This is what I really like to do, is identify key ranges in the chart. 46.66 up to 50.56. The way I calculated this range is just by looking at the range in this case. We got to push down, and once we found buyers, we rallied until we found sellers, or until everybody was done trading up there, right? You saw rejection as 50.56 and 46.66. That gives you a midpoint of the range at 48.61, and now this becomes my key range for the upcoming several days. We'll see how it plays out. but prices were offered at the upper quartile, upper quarter of the zone, and then eventually squeezed late. And now here's your 50, okay? Now, if prices can't establish acceptance above 50, look for price to drop into the center of the range at 48.61 with a shot to see 48 and the bottom of the range. So that's why 50 is very important up here, because if we can't get above 50, there's going to be a lot of buyers that are going to be forced to liquidate, and that's going to spark a sell-off back to these key levels. But overall, anytime you look at a range that's defined like this, with the low, the high, the midpoint, you're then able to use that range to extrapolate targets outside of the range. So once we do see range expansion from this range here, it could be significant. As a matter of fact, let's take a look here. If I squeeze this up just a little bit here, drop it a little bit, there's the upside expansion targets. So if we break this thing to the upside, and right now, you know that there's a good shot, because we have higher lows, we have a flat top, this thing is squeezing. Remember, I mentioned ascending patterns usually squeeze to the upside. Well, here's the top of that range. If we break through 56, then you have these expansion targets above, and this is your 25% expansion target, 50%, and this one right here is your 100% expansion target. And this right here, 100%, is basically equal to the range below, right? It's the same distance. And so that's why, again, when you're using price, you can just use price to extrapolate these levels. You don't need anything fancy. I do also use my ADR method targets in addition to that, but these levels are fantastic in and of themselves. So that's crude oil right there. I think it could be significant ahead. 50 is going to be the key level to watch. This thing, you got to be careful. You got to mind your risk when you're trading crude oil, because this thing has been routinely trading a point here and there very, very quickly. And again, $1,000 a point, you got to be careful. You got to mind your risk. Scale out of your position to reduce and eliminate that risk in the trade. All right, now let's take a look at gold. Let's look at gold for a moment. All right, here's gold in a higher time frame chart. And what I like about gold here in this chart is that it really woke up, because it was trending lower for some time, big time, and eventually really got snapped up off these lows. We had gold pegged for a long time. I really had some phenomenal analysis for gold for months, for years really. And recently we fell into a range and then got a squeeze off of the 1170s right here. This is 1170. And price bounced here off the 25% expansion level, 1133, rallied up, came back, higher low, rallied to new highs, came back, and then started to see absorption off the 1170s, and then saw expansion to the upside through 1250. That's now a key level. Price rallied, and I had the rally squeezing into 1309 quarter, or 1309s, because 1309 was the prior MC VPOC. We've now switched contracts, so that's no longer valid, but it came within a point or so of hitting that target. Once it hit that target, it came back and formed what could become a higher low above 1250. And what do we know about a trending market? You buy the dips, you buy the pullbacks, right? Look at all these pullbacks here that were bought. And of course, this was in a range, so it's not as pretty, but this is not in a range. This is trending behavior now. So this could be much prettier, for lack of a better word, more textbook. 1250 was bought here. Price pushes back to where? This is composite VPOC. Composite VPOC, 1280-280, and you can see the composite volume profile here. This is an LVN 1250, and that implies rejection. And this is an LVN up here, 1305s. That implies rejection as well. So right now, all that's happening is we're seeing traders trade the profile here. Their sellers are defending rejection and the LVN at 1305 and want to return it back to VPOC at 1282 and push it back to the bottom of value 1250s. And then bulls want to defend the bottom of value here and rejection at 1250 and return it back to 1282, and which they did, and then with a shot to take it back up. And that's basically the market. That's the general rhythm of the market. But one thing that I want to zoom in on right here in the chart, which is very, very cool, is that price is developing right now a double inside pattern. So you know inside days, right? An inside day is when you have the range of the current session, high to low, is inside the range from the prior session. You can see this high and this high, and you can see the current session was inside that range. But if you look over 2 sessions ago, the last Friday's trading was inside Thursday's range. So that's what I call a double inside bar pattern. Double inside bar, double inside day. These are very powerful. I created algos on these 10 years ago, 9 years ago. And this was a significant strategy approach because it really helped to identify when prices were coiling. It showed visual compression, and it really helps forecast the next 3 to 5 day move pending the breakout of this pattern. So what I'm looking for here is a significant breakout over the next 3 to 5 days based on this pattern. But I'm also watching 1280, 280 very closely. You have 1, 2, 3. You see this 1, 2, 3 days here where bears have been defending that level. That tells you that there are stops. There are buy stops above that level then. Additionally, bulls were able to successfully create higher and higher lows. This implies a squeeze to the upside. Now, we can break this thing to the downside and see a continuation, but I think right now the general idea is that we squeeze to the upside and rally into our upside targets here. And generally speaking, what I'm doing is looking to trade this thing to the 25% monthly expansion target or to the primary ADR target. This is my primary monthly ADR target. Again, another proprietary key level that I created based on average range over the last 10 months. So based on the average range of price, average monthly range of price over the last 10 months, if this is the low of the month right here for February for gold, then the projected upside target would be 1346.10 based on average range over the last 10 months. Now, we don't know if this is going to remain the low, but this gives you a very good visual representation of how far price can go on an average month. So that's why I make the 75% monthly expansion target my primary target, because you never know if price is going to trade in average range. So instead, if you drop that down, you have a much higher tendency to reach that 75% target. Well, you will always reach it first, but the percentages are in your favor. So if bears are unable to keep 82.80 offered, look for a squeeze first into the previous week's high, which is this blue dot, 1300, followed by a move into these upside targets. Failure to see acceptance above these 1280s opens the door to a retest at 1250, and a failure to hold 1250 is clear air back to 1210, and 1210 is prior MCVPOC. So it was the MCVPOC of this range. So that's the outlook here for gold as we head into February. I think we could have some nice explosive movement here out of this range very soon, and if we do, it could be a 3 to 5 day move into this range. So into these targets. So it could be a huge move. All right, let's take a look now at the NQ. Let's drop this down for a moment and bring up the NQ. All right, here's the NQ. And the NQ is very similar to the ES. We cover the ES at the top of the hour, and basically prices are doing much the same. Instead of having failed range expansion above the high of the range like the ES did, ES got above the highs and then failed. Instead, the NQ formed a lower high and failed. And then it saw failed range expansion here and rallied back to the top of value here. Then bears came in and defended the top of value and returned it back to the bottom of value. And these were all key reversals that we called at premium for our premium members. And again, I'm in awe of these trading ranges over the month of January, just fantastic. So anytime you throw a profile over a range, you're going to get the key levels that you need to pay attention to. And from there, it's all about picking your spot and using proper trade management. In this case, prices, I believe, are kind of rounding off a bit and have kind of a rounded top pattern, which is the inverse of a saucer or rounded bottom. And that usually implies a downside break. It usually implies a downside break. But again, I don't try to, I mean, we're right here at the center of the range. I'm not going to, it's just guessing right now. It's a toss-up whether we break this way or this way. But history favors a downside break given the pattern. But again, you have key levels to watch. You can see that prices are coiling with lower highs and higher lows, and that implies that expansion could be imminent. So we could be looking at February expansion that leads to movement over the next 2 to 3 months, very similar to the ES because this is a 3-month trading range. So we could be looking at significant movement ahead for the NQ as well. If we drop down into the lower time frame for the NQ, let's see. Here we go. Here's the lower time frame for the NQ. This is a 1,000. This is my execution time frame, 1,000 volume bar chart. Again, very similar to the ES. We had some nice reversals in this chart where price reversed off of the S3 band and reversed off the R3 band. So that's 3 standard deviations above VWAP. This is 3 standard deviations below VWAP. You can see how price got outside the range, and the way I teach it is basically, you know, you're not trying to buy it when it touches VWAP here because this is expansion. And then you can see how the market made it resistance here and dropped it lower. Instead, what you're trying to do is wait for price to pop back into the zone, back above it, make it support, and then rally. So you can see my algo basically caught it on the bar you needed it here, telling you to go long there instead of going long here or here or here, right? So this was a nice move, and it took you right back to VWAP, and then it took you all the way across, and then from here, overvalued again off of VWAP third standard, and it comes right back to value. Here's your late day range. Ascending wedge again led to late day expansion. Very, very similar to what usually happens after a scenario of that magnitude. Here's your overnight range here, and then what do you get? Expansion. So that's where I really always talk about price, value, price, volume, and value, because that's all it is. You know, it's about watching price range. This is price compression. Price compression leads to expansion, right? Expansion here leads to compression. You know, after you got this expansion, you pulled back and you got compression. And those are the basic market fundamentals there, right? So anytime I see something like this build out, I'm looking for expansion, especially late in the hour, last hour trading, when you've basically coiled up for 3 hours heading into it. So again, very, very powerful stuff here based off of just pure price range activity. But this stuff is something that works very, very well when you're analyzing price. What I wanted to do also now is bring up, let's see here. Let's bring up a web page here for a moment. What I wanted to do is just bring up PivotBoss, because there's a few things that I think you might really benefit from right now. If you go to pivotboss.com and you bring up, well, right, this is the home page right here, right away. But right here, dissecting crude oil's big day. That's a video there where if you click it, it'll take you to the post. And you'll see more about what I talked about that day when it came to the range expansion because of the failed range expansion that led to the big move up. And then I also talk about the VPOC shifts and some footprint sell imbalances or buy imbalances that went offered. So this is something that I think, you know, 8 or 10 minute video here that would really, that many of you may get a lot out of, so check it out. In addition, if you go again back to pivotboss.com, what you can do is up here on the nav, you have a lot of resources that are both free and also paid. Right here, free content. There's a whole lot of great free content, education. There's more PivotBoss Hangouts. So if you missed the January Hangout, you can go back and watch that recording. So if you click on Hangouts here, it's going to bring up all the recent Hangouts. So this is the one for today, where you can go back and rewatch if you wanted to. This is the one from last month, and then the ones from the fall. Additionally, you can go back and look at my PivotBoss commentary. I usually provide this every Monday. So every Monday, you're looking at all of the various analysis that I have for whichever market that I'm picking. Additionally, if you do not have my book, Secrets of a Pivot Boss, please, I implore you, this is one of the best books that you're going to find for trading around. I put a lot into it, and typically speaking, most traders and authors, they they try to whip something out very quickly for marketing materials. But this is a 300-page book, 314 pages to be exact, of nothing but straight knowledge inside. I mean, it is fantastic, and I thought so as I wrote it, but I really didn't know until others read it around the world. And I've gotten feedback for the last 4 years about how amazing this book has been for others trading. And I really hope that you you look into it as well. I mean, you can see, some of the great things that people have said about the book. It's really the cheapest way to get a great education right out of the gate. So if you're a newbie, or if you want to learn more about pivots, or learn more about some of the concepts that I talk about in the book, you can see here there's also kind of a little sample of the contents, so you can see some of the things that I'm writing about. Really, and here's the back of the book, the back cover. Michelle Schneider from Market Gauge gave me an amazing testimony on the back, which was fantastic. She loved the book and really had never read a book, she said, that was this good at talking about these concepts. And that was huge, coming from someone who was a former floor trader and current fund manager. So this is really when I knew I had something, and I really hope that all of you do check it out. Additionally, if you want, you can check out some premium content as well. I have a 2-week trial for premium. If you click on 2-week trial, you'll go to a page here that allows you to sign up for a 2-week trial, and then you can also see what others have said about it, and then you can see what the types of analysis that I offer. And lastly, if you want to get an even deeper look into premium without paying anything, check out our Getting Started with Premium series, and you can read all of these various, read and watch these various posts here that talk about premium and how to use it, because I really want you to get a look at premium before you ever spend any money, and just feel comfortable with what I'm talking about, how I present the analysis and information for our traders. So you can go in here and kind of test drive and see what I've done here recently using recent examples. And of course, you can also see all of our recent winners here. Well, not all of them. This is just whenever I have time to post something, because really I'd be posting every single day if I talked about every winner, and who wants to see that? But what I do, instead of just bragging about, hey, this is a 260-point move in the NQ, I try to teach you something about it. I try to say, hey, this is why it happened. I try to teach you scenarios of how you can identify this for the next time, or how to trade it. So I also always try to offer analysis that's both forward-looking and actionable for all of our members, even if you're not paying. So PivotBoss Masters is our training arm, and this is the best deal that you will get anywhere for training. And it's a lifetime offer. Basically, you pay once and you'll get education for as long as I'm posting this education. I mean, I'm just going to continue to post out course after course, year after year, and you only have to pay once to get in. And of course, you can check it out all right here, PivotBoss Masters, and learn more about that. But again, thank you very much for joining me for the February PivotBoss Hangout. It's been a pleasure having you all here with me today, and I look forward to many more of these in the future. So thanks for hanging out. Check out the recording, and give me any feedback you have. Tweet at me or email me. Usually Twitter's a lot better because I have 3,500 emails that I'm sifting through right now. But I always love your feedback. I read it all, and I try to respond as fast as I can, and I'm getting better at it. But I always love to hear your feedback, because it keeps me in the right spot, keeps me moving forward, and giving you exactly what you want. So that's all for today. I appreciate everyone hanging out with me today, and I look forward to doing this again next month. Everyone have fun, have a great evening, and trade well.